How's it going, friends and family? My name is Amos, and I buy stocks every single week, regardless of what's happening around in the world or what someone says on social media. I buy stocks every single week. And I think between you and me, one of the hardest things psychologically as an investor of the stock market is buying when the market is sitting at all-time highs. It feels wrong. It feels like you're going to be the last person walking into the party before the lights shut off, and you're caught holding the bags at all-time highs. If you take a look at your screen right now, the S&P 500, also referred to as the market, represented by Vanguard's VU, it's sitting at $695 a share, the highest that it's ever been in its existence. If we look at the data, the market spends more time at all-time high than in any other condition. For instance, the S&P 500 was at all-time highs back in August, July, all the way up to the end of 2019. And then again in 2021, it went back up to all-time highs. And again in 2024 and in 2025. And you fast forward to today in 2026 as well. The point that I'm trying to make is, in the past 10 years, you can cherry pick and say, oh, it was too high, I'm not going to invest, only for the stock market to keep going higher and to leave you behind. You could have said the exact same thing back in, December of 2017, when VU was roughly 249, saying it's too high, I don't want to invest. What eventually happened to the S&P 500? You fast forward and it just kept going higher and higher. Yes, there were some pullbacks and some corrections like the pandemic sell-off, but eventually with due time it rebounds and it rallies and it goes back up to all new all-time highs. But even then, December of 2021, the VU, the S&P 500, roughly $424 this year. You could have paused, pump the brakes and been like, dude, it's too high. I don't want nothing to do with the stock market. I'm going to wait on the sidelines. And then you would watch the stock market crashed, and then VU went all the way down to like $320 a share. And you might have been sipping on your little lemon tea saying, oh, I knew it. I was so right. Only for the stock market to rebound and rally to new all-time highs to $695 a share while you're still sitting on the sidelines. If you spend months that add up to years waiting for the perfect crash, the perfect opportunity to finally buy, you would have missed all of the enormous compounding that has happened along the way. I'm going to stop myself right there because I'm also not saying that you should give in to FOMO, the fear of missing out, while the S&P 500 at all-time highs, and to lump sum meaning you put everything full port, your entire life savings into VU, into SPY, or whatever index, ETF, or stock right now. Because hypothetically, worst case scenario, I'm not trying to say that it's going to happen, but it could, right? If the stock market crashes hard, violently, and aggressively, and we enter a prolonged bear market, it could take years to recover. Then again, what does the data say? Well, according to the research by Charles Schwab, does timing the market work? You scroll down, they lay out 5 different examples, and I will illustrate it on the screen so it's a little easier on the eyes. So based on the premise of putting $2,000 a year cash into the stock market every year for the next 20 years, adding up to $40,000 of cash in the timeline of 2005 to 2024, what would have happened from scenario 1 down to scenario 5? Perfect Peter. Let's say that he put his $2,000 at the lowest point the stock market was at every single year, which, believe it or not, is statistically almost impossible. Let's just assume he's Perfect Peter. Scenario 2 is Ashley Action. She put $2,000 into the S&P 500 on the first trading day of every year for the next 20 years. Right, so January 1st, sometimes January 2nd, sometimes January 3rd. And then there's Matthew Monthly. This is basically the 401k investor where he invests into the stock market every 2 weeks because a little bit of his paycheck is taken out and allocated towards his retirement brokerage account because there's also a matching contribution from his employer. So dollar cost averaging. And then there's Rosie Rotten. terrible market timer, and she put her $2,000 into the S&P 500 every single year at its all-time highs. And then last but not least, scenario number 5, Larry, he stayed predominantly in a cash position in treasury bills or a money market fund. As you can see by the results of the study, everybody that stayed invested in stocks, they came out ahead over that 20-year period. The $40,000 in cash, doesn't matter if you were Perfect Peter or you were Rotten Rosie who invested at all-time highs, the difference between $186,000 to $151,000, yeah, it's a significant amount of change, but the only loser in this category is Larry, the one who sat on the sidelines with a predominantly cash position for the entire 20 years. His 40 grand would have transformed into $47,357. If I was Larry, I would absolutely be upset with myself, because had I just bought into the stock market at all-time highs, I still would have came out ahead, $151,343. I mean, obviously we all want to aspire to be Perfect Peter, but the stress, the logistics, and the gambling aspect of trying to time the market perfectly, it's difficult. But to be somewhere between an Ashley or a Matthew, systematically and a disciplined approach of dollar cost averaging, I would still be a happy camper at $170,000 or $166,000. And if you're not a fan of the cartoon graphic that I showed, this is the one that Charles Schwab shows. So the only loser is Larry. Now, I do want to caveat this by saying, circling back to what we were talking about prior to that example, an investor who bought the S&P 500 at the exact peak of the dot-com bubble on March 24th, 2000, that specific investor, they needed patience, because for them to break even 2007, but to break above their purchase price in 2000, it would have taken 13 freaking years. And that's why the 2000s, it's often called the lost decade for the US stock market, because the S&P 500, it produced roughly 0% annualized price returns from the year 2000 to 2009. And then, of course, what happened in 2009? The great financial recession. So even though your portfolio would have been at 0%, it would have taken a nosedive and gone back down 40-50% in the red. So to be a stock market investor in 2000, 2007, 2009, probably wasn't a fun time. And so between you and me, learning about periods like this during my business school MBA journey, it helped shape my investment philosophy and reinforced my preference for dividend growth investing. That way, I'm still paid even when the stock prices go nowhere for years, for up to 10 years. Can you imagine doing growth investing and your portfolio staying flat for 10 freaking years? But anyways, I digress. Ever since learning that lesson, I've been more interested in buying into fear than chasing whatever happens to be popular at the moment. 99% of the time, whenever I operated with the lens of FOMO and jumping into something because it's soaring and trying to jump onto the rocket ship, 9 out of 10 times, it has ended in a negative way for me. Not fun. That's why I do not like FOMO investing. It's not financial advice. Instead, what I like to do is use more of a top-down investing approach. I first assess the broader market to see what's going on, and then I look for the sectors or industries that are out of favor and experiencing heavy sell-offs, because I understand that rotations happen. Sometimes, for a period of like 2, 3, 4, 5 years, your sector and your industry might be out of favor. You might be in the red. But eventually, with due time, the rotation happens. It goes from value into growth, or growth into defensive cyclical, or sometimes into consumer staples. Rotations happen. And then once I dial into a specific industry or sector that's like 20, 40, 50% into the red from the top to the bottom, the best company to the worst company, I zoom in and I examine the individual companies within that industry to identify the highest quality compounders trading at attractive valuations instead of chasing overhyped stocks already priced for perfection. I'm telling you right now, if you buy into a stock out of FOMO that has a trading multiple of 500 times their earnings, PE ratio of a 500, they are priced for perfection. If anything happens, if there's even a typo on their earnings report or on the PowerPoint that they produce, they could go 20% into the red. Some analyst on Wall Street is going to be like, look at the carelessness of this company. How dare we invest in them? Let's punish them. Negative 30% for you on a single trading day. A 500 PE ratio, it might seem like it's perfect and it's beautiful, but I'm telling you right now, if there's any mistakes at a 500 PE, that stock, the volatility and the swings, just not my cup of tea. So having said that, this is a breakdown of the S&P 500. Now let's take a look at the sectors and industries of the entire stock market. And in the stock market, there's 11 different sectors ranging from the financials, like the big banks. You've got the utilities, the ones that provide power to your house. We've got real estate, energy. And if I click the overview tab, it breaks it down to a more nuanced view and a micro lens. So out of the healthcare space, for the longest time, the biggest opportunity, the undervalued plays were the health insurance stocks like Humana, United Health, Centene, Elevance. I think that ship has sailed. Because if you take a look at the 1 year change, now it's 22% into the green. If you did not buy into the fear last year, it's too late. But as of right now, there is another opportunity in the healthcare space, right? Medical devices, for the past 1 year, past 5 years, it's in the red. So what I would do, I'd be like, okay, that has my attention. Now I'm going to try to figure out what's going on. I take a look at the landscape. Is it all narrative based? Has the fundamentals changed? Has AI disrupted their overall business model? And then I click medical devices to take a look at the names that are in this industry. There's Abbott Laboratories, which is a core holding of the Cheese portfolio. There's Stryker, they help do artificial kneecap replacements. There's Medtronic, a company that we just analyzed on this channel, so watch that deep dive video. There's Boston Scientific Corporation. They do a lot of like artificial heart parts. Edwards Life Sciences, also artificial heart accessories and valves. And then as I decipher the names and I get familiarized with who makes up this landscape, I look at things such as the valuation of the company itself, right? Even though they're 50% in the red, are they still trading for a 100 PE ratio? Or is their trading multiple less than the S&P 500's average? And at the time of making this video, the forward PE ratio predicated upon next year's EPS for all of the various companies that are in the S&P 500, it's a 22.8. Now, historically, since the era of the internet, since the year 2000, it usually sits at around a 16, 16.5, sometimes around a 17. So to be at a 22.8 for their forward PE ratio, there's a lot of optimism in the stock market. So I do a quick benchmark to the S&P 500's trading multiple. Abbott Laboratory is 15. If I compare themselves to their own timeline and against themselves, on average, for the past 10 years, their PE ratio is a 50. So they're way, way below their own historical valuation. Likewise with Stryker Corporation, the exact same thing with Medtronic. And then I also asked myself the questions such as the quality of the business model. Is it a cash-producing asset that's intelligent with their capital, or are they burning cash to stay relevant on useless R&D projects and throwing money away? Or are they strategic? Are they doing share buybacks? Are they increasing their dividend payout? Are they being smart with their money? And something else that's really important, is the business in question improving its earnings year over year? The earnings is the profits per share. I need to see that number be growing. If not, the free cash flow per share, a really good proxy to figure out the cash from the operations, that should be trending in the right directions. And then also, how durable is their economic moat, the competitive advantages that keep away the competition? That's why on this channel, very unpopular opinion, but I really like capital expenditures. The bigger your physical fortress that you build out to increase your economies of scale or whatever it is that you're trying to do, for a startup to raise that much capital to compete with you, so much more difficult. So I like CapEx. I actually have a dedicated video that's a lot more coherent and intelligent as to why CapEx is a good thing, if it makes sense. If you're doing CapEx for CapEx sakes, no. But if there's a strategic game plan in order to boost your revenue by 2 or 3x in the next 10 to 15 years, and it makes business sense, yes, I bless off on it. And it's not just with the medical device space. You take a look at all the other industries, there's so many more opportunities. You also have the insurance brokers. You also have basically everyone operating in the assurance space. And then when you take a look at the technology space, everyone and their ex-wife should know that the software stocks are getting hammered. Actually, today they had a pretty good green day, including Salesforce, even Adobe, Intuit, and Microsoft. I think the stock market is finally waking up to realize that AI can only benefit the software applications. It's going to make them more nimble, more lean, more optimized and efficient. To think that AI was going to make software obsolete, I always thought that was the most silly argument. If anything, software should now be stronger and better because a lot of the features and tools will now have AI augmented into it and make it better. A better experience for the user on both ends, for the company and for the customer. That's neither here nor there. I bought into the software sell-off, so that's there. And also, if we take a look at the industrial space, I really like the industrials because there's a lot of CapEx. And if you take a look at the Cheese Portfolio series, that's where I made my biggest bucks through investing into CapEx heavy companies like the railroads, the military industrial complex, 3M, and so forth and so forth. You scroll down, you can see there's a lot of industries that are really beat up, while the rest of the market, mainly the AI data center bubble, while they carry the rest of the S&P 500 to new all-time highs. So once I find my compounders that are undervalued and have a pretty stable and high-quality business model, I do a tactic known as dollar cost averaging. What exactly does that mean? Let's go ahead and assume that I have $10,000 in cash. Instead of going all out with 10 grand into a specific position, ETF, or stock, I nibble at it a bit at a time, especially on red days. So I buy the opportunities on red days instead of trying to perfectly time the market. And how that frequency and cadence plays out is usually like once a week. Sometimes it'll be multiple days across a few weeks, like with Microsoft. I was buying heavily when they were dipping down below $400 a share, when they were flirting with 380, 370, 350. I kept dollar cost averaging, meaning I just kept buying a little bit here, a little bit there, instead of going all out when they had their first initial drop to like 440 a share. Does that make sense? So that's dollar cost averaging. Now, on paper, people would say dollar cost averaging in the true sense is to systematically buy whatever it is on a frequency or a timeline without any thinking involved. So every 2 weeks or whenever the paycheck hits the account, I am buying XYZ. That would be dollar cost averaging, but I modify it to where it fits my risk profile and tolerance in a more customizable manner. Because I wouldn't want to buy into Microsoft when they're at all-time highs, if that makes sense. I would like to buy into them when they're below my fair value estimate. So to buy them at 380 a share, that's a huge margin of safety, knowing full well that in my heart, I know that Microsoft is at least 585 a share. So to get them at 380, dude, that's a bargain and a steal. At the same time, I also think it's strategic and it would behoove of you and me to build up a cash position from your active income in a high yield savings account or a money market fund that gives you some interest so that when a market-wide sell-off happens, because it will, like we witnessed in the 2020 pandemic crash, the 2022 bear market, the April 2025 tariff situation, or even in 2026 with the Venezuela and Iran crisis, the stock market went on a huge correction. And so the next time something like that happens, you'll be ready. You'll have cash, some gunpowder on the reserves to reload that musket so you could take aim at what you like and start purchasing. But I'm going to tell you this right now, psychologically, when that happens, when everything's going 15, 20, 40% into the red, psychologically, it's going to be very, very difficult. It might feel wrong and even a little dirty, but that's exactly when I plan to buy big into the fear. And it's exactly what I've been doing since 2019. When I see fear everywhere, dude, I know it sounds wrong, but I get really optimistic. Because you can make money in a bull market, but you can make fortunes in a bear market. When everything goes on a sell-off and you know it's an otherwise high-quality compounder on a discount and it's irrationally being punished alongside with everyone, that rebound, when it happens, Boy, sign me up. I'm not trying to say that past performance is indicative of future gains. But when you try to tell me that a company like Microsoft is going to go belly up, that's when I'm going to side-eye you and be like, brother, you do your thing. If you believe that, don't buy Microsoft. Let me buy the Microsoft, okay? But jokes aside, I wouldn't go as far as Berkshire Hathaway and be predominantly cash to time the market. Because as we learned, friends and family, time in the market beats timing the market. Remember, the only one who walked away as a loser over the 20-year experiment and study was Larry. The one who was in a huge cash position on the sidelines. 40 grand would have turned into 47 grand. So me personally, my mentality, today's all-time highs are tomorrow's lows. So that's why I dollar cost average every single week. What I mean by that is today it might look scary and it might look like, oh my gosh, are we at the top yet? But if you zoom out and think about this 5 years from now, 10 years from now, brother, today, June 2026, it'll be like, wow, I really wish I would have bought back then because now it's this much higher. And on that note, it really bothers me that people lack delayed gratification. So many people treat the stock market. You call yourself a Warren Buffett disciple. You say that you follow the principles of value investing and dividend growth investing, and yet you get irritated and pissed off when you buy into a stock and it doesn't move for weeks or for months. Friends, family, patience, that's the key word. Whatever endeavor you are in, your career, your family, your relationships, your professional development, whatever it is that you're doing, patience. It takes time for things to pay off. The ROI is sweet. If you're a fat lard and you go to the gym, you work out once, you're not going to notice any difference. But you go to the gym every single day and you work out, that tubby belly fat will disappear and melt if you look back 2, 3, 4 years from now with consistency, with discipline. So patience. Just because you buy something and it goes a little further into the red in the next month or the next year, you sweat, you get anxious, you stress out. It's like, brother, I buy stocks with the mentality of, I have to hold this for the next 10 to 20 years. That's the mentality. Sometimes I sell out of it within a year, within 5 years, because they go way beyond my fair value estimate and I feel fine with capitalizing on the profits. Okay, but if it doesn't work out that way and it trades flat or it's volatile, I'm okay. I'm sitting back and I'm collecting the dividends. I don't know why so many people are so impatient and insufferable when it comes to their stocks. Y'all treat it like it's supposed to be a casino and you're gambling and it needs to 10x overnight. That's not the right mentality. Because if you do that, you're going to keep chasing the next lottery ticker, and you're going to potentially lose all of your money by playing that game. It's not fun. Yes, if you're on the winning side and you make it out big, and if that were me, I would take the entire winnings, put it into SCHD, delete everything, not even look at the stock market, sit back and collect my rents from SCHD, call it a day, and never consider stocks again. But the reality is, for most people, that's not going to happen. 99% of the people, it's going to end poorly. You're going to be caught holding the bags as you try to jump on as the hedge funds and the ones that are trading using an algorithm, they walk away with 1,000% profit. So anyways, the slow and steady value investing compounding method, it takes time. I will say though, with the number of companies rushing to IPO in 2026, it does make me pause and ask whether we're getting a little too euphoric and optimistic in the stock market. Because historically, the data shows us that's often when investors are just feeling way too greedy and saying we need to go public right now to squeeze as much value as we can get. That said, I'm not going to be the guy that's going to sit on the sidelines trying to time the market. So I'm going to continue dollar cost averaging and putting my capital to work so that it can compound. What say you? Anyways, I love you guys. I hope you learned a thing or two and you got some value out of this. Good luck in the stock market. Stay safe, and I'll talk to you all next time. See ya!